Hello, everybody. Kirk Spano. This is the September question and answer. This is the call that is replacing the Saturday calls because I am going to be doing prepackaged stuff to release for weekends going forward. And I still want to give you a chance to ask me questions outside of the Monday options call and stock call. So on Mondays, you check in stocks and options, and then the monthly call. And this kind of coincides with the ETF articles. We do a monthly call to cover everything. You know, if you want to talk about macro, you want to talk about asset allocation, you want to talk about a company, go ahead and ask the question, and we will go from there. So there were some questions, and I'm going to just kind of work from the top and work my way down. So the first question had to do with saving money for kids. And Ricardo here says, in addition to 529 plans, I have UTMA accounts for the kids, and currently has some VU, which is S&P 500, Berkshire Hathaway, McDonald's, Nvidia, some other stocks. So in short, the way that I have done this, and doesn't make it right, is the 529 plans, which are the bigger asset allocation, use funds, right? So that's your broad diversification. In my opinion, you don't need the S&P 500 because in your 529 plans, you're going to have a bunch of funds. The way I have done it, and because it's typically the smaller amount of money, is you buy one or two stocks a year. You focus on mid caps because that is where you have kind of that blend of growth. You're past the startup phase or the early phase where something can fall off a cliff, and you're big enough to have some safety. So I like the mid cap focus. Buy one or two stocks a year. You can buy some small caps. Try to avoid things that are outright speculative. It's hard to do because we try to project and we convince ourselves that we're not speculating, but we're speculating. And so you want to control yourself on that. The stocks that you have here, I wouldn't bother with Exxon, great big company that is facing secular headwinds. Berkshire Hathaway, I think that that's your substitute. I think that's a unique company. They're sitting on a $500 billion in cash and short-term bonds, 2 to 5 year notes. So they have something big planned. We did just get news on Berkshire Hathaway. Agent Jane, who's been running the insurance operations for like 40 years, sold half of his shares. I think he's on his way to retirement. He's in the 70s, and it's going to be Able that takes over the company. We already know that. And they just bought Chubb, or they're looks like they're in the process of buying Chubb. They took a large position, and I think they might buy Chubb out. So if they buy Chubb, they get the CEO, and they get that bench of talent to help with the insurance operations. So I think that it's pretty likely that Berkshire Hathaway buys out Chubb. I think that they get to 50% ownership of Occidental in short order now that the stock price is tanked. And without the support of Berkshire buying the dips, Occidental's down to what, 52, 51. Suddenly you're like, whoa, maybe I should just outright buy the shares. And that's a stock that we have been selling cash secured puts on. I think I've sold cash secured puts on Occidental and had expire 6 out of 7 times. It's just been a wonderful trade. And I haven't done it lately, but I think I'm going to be looking at Occidental very seriously here in the next week or two, because I don't want to get caught finding out that Berkshire just bought a zillion shares again. I like Rocket Lab here, AST Space Mobile. I think Nvidia, there's going to be a spot to buy Nvidia, so I think you probably add that. Not a big fan of O. I think that that's more of a retiree stock, So I would focus on finding about a dozen mid caps with a few small caps, maybe 4, 5, 6 small caps. You could get up to 20 stocks over a number of years, but that's the way I would do it. Now, that doesn't mean it's right. If you're just more comfortable doing a more diversified approach, all cap, have at it. But I would focus on the mid and sprinkle in some large and small, depending on if you can find some good deals in large cap, like Nvidia on a pullback. The thing that you're going to see NVIDIA do, and I'm going to write an article about this just to get the clicks, is that Supermicro and NVIDIA are going to go through a breakup. And NVIDIA is going to stop prioritizing their relationship with Supermicro because Supermicro has not been a good actor with accounting and with deliveries and with service. They've really done everything wrong that you could do. That stock is down from its all-time high, 50% already. I think it's going to drop another 50%. So I think Supermicro's in trouble. And NVIDIA is going to pivot over to Dell and HP and just move the chips in that direction. There's a shortage of chips for all the people that want them. So they're going to basically tell Supermicro, to the back of the line. So Supermicro is one that people who are saying buy that right now, they don't know what they're talking about because they haven't made any phone calls. The channel checks say that Supermicro is in trouble, and this is not a value buying opportunity. If it gets down to in the hundreds, maybe. So that's the way that I would handle the UTMA accounts for the kids. Is just build yourself a nice mid cap portfolio with some small and large around there. I don't think you need any funds. Berkshire kind of acts like a fund. So, I think it's really close to what you're doing. I do. It's not bad. Lockheed Martin, that if you can get it when it's cheap, which it never is, but if you can get it on a correction, just goes up over time. Not always beating the market, but generally heading up. And there's not really much long-term risk in Lockheed Martin, right? They have such a diversified business that they can't go down the tubes like Boeing did. Now, Boeing, on the other hand, at some point, there's a price that you want to buy Boeing because they still aren't in an oligopoly. They're going through a period of transition. And you got to think that Boeing rights the ship, rights the plane, hits the plane in the right direction at some point. But I'm not sure when that'll be. So I'm trying to figure it out. I am. Boeing's interesting to me because it's an oligopoly stock. And, that's what you want. You want oligopoly stocks because they have pricing power. And the fleet of airplanes, just like the fleet of cars, is really old. So there's pent up demand. And at some point, they should be able to figure it out. I have thought about Boeing to the point where I'm thinking maybe they should sell off their space. They should separate the airplanes from all the other stuff. I think that there's some reasons for them to look at strategic transactions. If they do that, should be pretty interesting. So somebody asks about technical indicators, so we'll go through that. They want to take a look at AST Space Mobile in particular. We'll take a look at that. Somebody asked about writing covered calls on IIPR. I actually have that chart ready to go. So innovative industrial properties. Look at this chart. We bought it. I mean, we really bottom ticked this one, right? We bought this one at all the right prices, and it's just been going up. Look how good that chart is. There is no reason to write a covered call on this before it's at about this fib line. That's a 618 area. So maybe around 150, you write a covered call if it's been up here in the overbought range for a long period of time. I don't think it's there yet. I think at 126, I'm not interested in getting this one called away because I think ultimately, depending on how it jitterbugs, it's going to get to around 200 again at some point. Now, does it break out and set a new all-time high? Hard to know. I think maybe you need a strategic transaction for that to happen. But I'm not messing around letting this one get away from me. It pays a big fat dividend. Just take your dividend and let it get up here and then think about it and then let it get up here. And then that's probably where you really probably are looking to do something. All right. Somebody asked about AST Space Mobile. Let me get that up. There you go. So here you go. SPAC IPO, and everybody hates it. And I've been saying since last year, back up the truck. So for a year, I told you to back up the truck, and there you go. Now it's pulled back because maybe it got ahead of itself, but I'm not so sure. This is a company that I think you can pretty easily say is worth at least 25-30 billion dollars. It's trading at like 7 or 8 billion right now. It's probably worth 50 to 75 billion, and maybe it's worth north of 100 billion. So until it gets to 20 something billion, I just don't see that there's a lot of reason to trim this. I don't think there's a lot of reason to write covered calls. Now, right here above 30, I told you to go ahead and write some $50 covered calls, right? Way up here. And for like 3 days, you could do it, right? It didn't last very long. Take this down to the daily chart, right? It only lasted, you only had a few days to sell the $50 covered calls. So I have $50 covered calls out there for like against 20% of my position. They're just going to expire. If suddenly the stock goes way up to 50 and it gets called away in a couple months, I'm okay with that too, because it has become a very big position for me. And, I manage other people's money. I have not even written the cover call on my personal account, though. I'm waiting until it's in that 20 plus billion range. And then, because that's another triple from here. Then I have to figure it out, right? Then I have to figure it out. So always think of things in terms of market cap, not share price. If you think of total addressable market, in the billions, however many billions of dollars that is, the market cap of the company and their revenues and their potential revenues and their margins, and you can do, a range of approximations on what this should be worth. And remember, the analyst estimates, the ones that are published, are for 1 year. This is what it should be worth in a year, is what they're telling you. And the range on this one is in the 20s and 30s, is what they say it should be worth in a year. But I think the better question to ask is, what should it be worth in about 4 or 5 years, right? That 3 to 5 year window that we talk about. Once they have all the satellites deployed in the next couple of years, 18 months, 2 years, whatever it's going to take, and they have everything optimized, and now they have reach to like 4 billion people. How many people are going to pay $10 a month if you're in the first world, right? If you're in the United States, are you going to pay $10 a month to AT&T or Verizon to make sure that you always have coverage no matter where you are? You probably are. And you might turn it on and off. The 1 month you might pay for it because you're traveling. 1 month you're sitting, a mile away from a cell tower because you're at home. Maybe you don't that month. So you might turn it on and off. But what if you're in a third world nation and there's not a lot of cell towers, and you got these little cell phones that are on 3G, which is most of them are, and they tell you, hey, if you buy a 5G phone, right? If you buy a smartphone, we now can hook that up to the internet, and now it's like a computer, right? For them, it's a computer, and maybe they buy a little bit bigger screen. I would think that iPad sales might be a big deal, as the emerging markets have the ability to send a voice or internet signal directly to something that's hooked up to a cell network. And a lot of these cell networks, you got to go to a location to use it. So this really broadens the cell availability at 4G and 5G speeds around the world. And that's really what is a big deal, is they're bypassing the need to have a tower standing there, right? The cells can work in a way that the range is greatly improved because you got the satellite beam, and that's, I think, what is coming to a lot of the emerging markets. So while we might pay $10 a month because it's a luxury, for other people, they're paying $10 a month for like total connectivity because it's just a mind-blowing leap. After, do you remember what 2G and 3G was like? And now you have 5G phones that are, just getting the 5G. Most of them are kind of like 4.2G. But, you take a look at what you have for speed and download capabilities and voice with the phones that you have, your iPhone or whatever. Imagine billions more people getting that, and it's new to them. We get frustrated because, oh, my internet is downloading slow, right? It took 7 seconds. If there's billions of people who are going to be, hey, I don't have to go to the library to use the computer anymore, or wherever it is they're getting their connectivity. They just pick up their phone, right? They they make their transaction, whatever it is they do. So I think AST Space Mobile is just a huge deal. They've proven the technology already. Now they just have to optimize it for, larger network. So I'm not messing around with it. I think that you're in a range, right? It came down into this range. See over here, there's a bunch of support. That's what this band is. This is institutional support. Now, can it fill this gap right here where there's not a lot of support? These are volume bars. And where you have these holes is usually where you get a change in direction. So that's low 20s, right? This is what the Elliott wave is saying. So, AST Space Mobile is close to a buy price again. You should really be selling puts more than anything. Somebody asked, am I worried about the cash position with Metis? I'm not sure how long you've been with us to ask that, but Ametis has a relationship with a firm called Third Eye. And Third Eye has lent Ametis a lot of money over the years. They've helped them get through COVID and higher rates and regulatory delays. It makes zero sense for Third Eye, which holds almost all the debt, to put the screws to Ametis. Why? Because Third Eye is an equity holder and a debt holder, and they have a debt fund. If they put the screws to Ametis, what does Ametis do? Somebody puts the screws to you because you're in debt. What do you do? Somebody put the word up there. What do you do if you're in so much debt and somebody puts the screws to you to give them cash? What do you do? Do. Wrong. You do not sell more stock. Do. Stop making payment. And then what's next? Bankrupt. Yep. BK, baby. So if Third Eye would ever play hardball with Ametis would declare bankruptcy, wipe out that, the shareholders, wipe out the stock. Now, Third Eye has to try to run a refining company. Well, you know what Eric McAfee is going to say if his college buddy screws him? He's going to say, right back at you, right? That's what he's going to do. So this sort of relationship has been out there with all sorts of companies all over the place, where a buddy is in debt, a financing company, right? The debt provider, and then somebody's starting a company and they need financing. Now, the financing with the Metis, this is all taken a few years longer than it should have. COVID played a role, rising rates played a role, regulatory delays played a role. You can't change that stuff, right? All you can do is work through it. So now all of a sudden you have an India refinery that is cash flow positive to the point where they're building more refinery without borrowing money. And they're going to IPO it and take some 9-figure amount out, right? When they IPO it. So with the Metis, all these knuckleheads are saying, "Oh, they don't have cash on their balance sheet." Well, no shit. They're growing the company. They're building freaking refineries. So, it just takes an incredible lack of knowledge and a big glass of ignorance to not understand how the CapEx cycle works. And, ignorance is just a product of inexperience. So, some of the people who read it and they're like, "Well, I don't understand." That's fine if you don't understand. But the people who are spewing it, they have a motive, they have an agenda, they want to beat something down. And there's a lot of that out there. The shorts are coordinated across many companies. They use Discord and trading rooms. Okay, where can we find something that's thinly traded, that's in a CapEx period, where the numbers aren't going to, be easy to read for people? How do we scare them out of their shares? And how do we make money on the short? And that's what they do. And then at some point, they're like, okay, well, they got 3 or 4 or 5, 6 catalysts lined up. Let's cover our shorts into the fear and go long. Is it not easy to see that with AST Space Mobile? This was an incredibly heavily shorted stock for 3 years. And then boom to the moon. And it's not even all the way to the moon yet. It's just leaving orbit. Just left orbit today, actually. You can go online and you can see the launch. So, those satellites are up in the air now. They're going to unfurl the arrays. So, yeah, you shouldn't worry about a Metis's cash flow position or cash position because it just doesn't matter. They've run on zero cash or almost zero cash for a decade because they have a financing partner who's got equity and it's in their interest for the value of the equity to go up. Doesn't make any sense for them to kill the equity and take a haircut on the debt. What would their debt fund holders think if all of a sudden something that they bragged about last year, which they did, they said, "Oh, we're gonna take a 50% haircut on the debt, and we're gonna take and it's all coming back to you in equity. You don't get your return anymore, and now we have to figure out how to run a refining company because the management said, screw you, we're going home." All right, so Enovix. So Enovix is an interesting story. They have some big orders And I think that we probably get a pretty good rally here with NFX. I have taken a look at some of the articles, and everybody is just so stupid. You know, the inability of a lot of these bloggers, and they're not analysts, they're bloggers, to not understand how capex cycles work is pretty silly to me. So Enovix is building a factory, right? And they're getting orders to fill the cell phone orders is what they are. They're getting into mobile devices, and they're licensing out their technology, which we talked about ahead of time, right? So I told you they were going to license out their technology in spring, because why build a whole bunch of factories when the car companies want to do it their way? Just license them the technology and collect a royalty. So that's what they're doing. They've already done it once, and they're going to do it more. I believe it was Hyundai, but I could be wrong. So, Hyundai is a big company. I'm looking at buying a Santa Fe right now. So, when you take a look at Enovix, you have to figure out, all right, what is the potential upside here? Well, the potential upside is literally several $billion of revenue pretty quick, like in the next 2 years. Their market cap is 1.5 billion. This is a stock that could go to 20, 30 billion in market cap in the next 3 to 5 years. I mean, this is a potential, 15, 20 bagger from this market cap. They have the really big short interest, 27% or whatever it is. When those guys have to cover, then they have to cover. And think about this. This is all they could achieve. They couldn't drive it to zero, and then it started to turn around at about $8 a share. It's going to jitterbug, and then when the whole market turns around on greater liquidity, you're going to see a lot of these stocks really go up a lot. So we know from Apollo Management and everybody else who's done the studies, higher liquidity in markets drives higher asset prices. So what do we know about what's going on right now? So at the start of the quarter, I told you, right? There's rate cuts, a rally, and then a crash. And the crash is like 5 years out, give or take. So the rate cuts are starting a virtuous cycle. And I had two phone calls today, and I exchanged text messages with somebody. The people out there who are holding cash are, for the most part, millionaires and 100 millionaires and hedge funds. And that's where most of the excess cash in money markets is coming from. So you have $1 to $2 trillion in money markets. It's not your money. It's not, well, I mean, some of you maybe, but it's not mom and pop money. It's big investor money. It's the type of people who invest in multi-million-dollar building projects. And that money is going to find its way mostly into building, redevelopment, and some of it will go in the stock market and Bitcoin. So higher liquidity, remember, gets leveraged. So if you're borrowing money to build something, you're taking a bank loan. Maybe you put 20, 25% into the project, and then the rest is financed by the bank. Sometimes you got to put down 30%. But the banks are in a pretty good position to lend money if they don't have a commercial real estate problem. So that's a lot of banks who are going to be able to lend money, and you're going to see 4, 5, $6 trillion go into building over the next several years. So the projects that were halted a year and a half, 2 years ago because of rising interest rates, we're talking about funding one of those deals right now. And then there's going to be more. So, if you own land, if you own a dilapidated building that you're ready to knock down because you squeezed the last dollar rent out and it's time to build something new, you find a partner and build something new, because that is money from heaven. That you don't have to sell it, you just upgrade. And now suddenly you get to take advantage of depreciation and low cost financing that's coming. You end up getting 15 to 20% internal rates of return. And if I'm right, and I'm pretty sure I am, and there's this direct correlation between asset prices and tax receipts, we're going to see a big bull market over the next 4 or 5 years. Now, again, when the last boomer is on Medicare and almost the last boomer is on Social Security, we're going to have to figure some things out. So we'll see where we're at in 5 years. But I think whoever walks into the presidency next is walking into a pretty good situation. I mean, Biden, got the Inflation Reduction Act passed, and that's an of the above energy strategy, really. He got the Semiconductor Act passed, and now we have all kinds of semiconductors coming back. And, really don't have to worry about Taiwan getting invaded, really. I mean, we are, but we're not going to lose our chip capacity because of it. And the infrastructure bill. So all of a sudden you have airports that are getting, additions. So we have one coming in Milwaukee, they're reopening a terminal. So, you take a look at what was set up. Yeah, was there a lot of spending? Yes. And I know that people go, oh my God, we're $32 trillion in debt. 2/3 of the interest on the debt, where it goes? Back to America. And in fact, that's the non-government owned debt. So actually, it's something around 3/4, 78% of all the interest on the debt stays right here at home. We're just taking it from our right pocket and putting it into our left pocket. So it's different if most of your debt is financed outside of the country, but most of our debt is not financed outside of the country. I actually posted a link to give the breakdown of debt, and it's just the debt problem is way overstated. We're going to be able to cut our interest expense by 1/3 just by lowering rates, maybe in half if we lower them even further. So the bullet point, the buzzword, they're all the buzz phrase they're all throwing out right now is, oh, we're spending more on interest on the debt than we are on defense. That's always been bad. Well, kinda. But yeah, but we control interest rates. So if we lower interest rates, then what we're spending on interest payments goes down a whole bunch. And, I think there's a pretty strong argument for flattening defense spending. So, instead of increasing it every single year. So what happens if we lower the interest and everything grows and all of a sudden asset prices are up and employment is high? Oh, that sounds like a pretty good recipe, right? High employment, not unemployment, employment, right? Unemployment is low. People are putting money into retirement plans. They're buying houses. They're building houses. They're building apartment complexes because all that trillions of dollars that was released because interest rates went down, internal rate of return on projects went up. Lowering interest rates is going to increase liquidity. They're also cutting quantitative tightening. Folks, you are about to see a big economic expansion. The recession is already almost over. Yeah. You have had rolling slow periods, industry to industry, all year long. They're almost done. How do I know? So you have the negative economic surprises. That's this line. And you have interest rates, this line. What always happens, right? The alligator jaws close. How are the alligator jaws going to close here? Interest rates are going to come down, and then the surprises start to become positive. We're already at that point. Look right here. Look at this right here. Same thing. Oh, up. Same thing. Interest rates are going to come down. Surprises start to be positive. This is going to take about 6 to 9 months. That's all it's going to take, between 6 and 9 months, and you're off to the races. And we can see the cost of outlays on debt. So everybody says, oh, look, the outlays on debt are really, really high. But what happens if interest rates come down? Then they come down and the leading indicators go up. That's what we're seeing here. We have a projection that things are going to get better. So interest rates come down, surprises start to be positive. Interest expense starts to come down, surprises start to be positive. We're within months of that. Small business, we're very low on confidence. Interest rates are coming down, and it doesn't even matter who gets elected for small business, I don't think. I take it back. I think one is better than the other, but I think they're both good for business, right? Trump does it his way, and Kamala is going to do it her way. But I think small business has a big improvement coming. I think really small business. I think like you find an empty building that a boomer used to have a business in, and you buy it and you run your business there with low overhead. I think that's going to be really good, especially if they go through with the $50,000 tax incentives for getting a business started. So if they're not going to tax you on the front end, which is that not the argument that I've made forever and ever, is help people get started, right? You don't have to charge them taxes right away. Let them build their business and get a footing, and then start charging them taxes. So I think one way or another, small business is also bottomed out. I expect a generational, and I've seen it with my daughter who owns a business, 25 years old, making six figures. I think you're going to see a lot of Gen Zers in particular because they seem very entrepreneurial. But I think a lot of millennials who lose some job satisfaction as AI, infringes on their creativity and ability to interact. And I just think there's going to be shifting. So I think there's a lot of people who are going to open businesses. And given that AI tools are so cheap already, remember I told you 4 years ago that I was spending like $20,000 a year on an AI system. Essentially, it was like Bloomberg, but it had AI built in. And now Bloomberg has AI built in, and that's about $25,000 a year. But you take a look at Perplexity right here, and Perplexity gives you five different search engines. Where's my little? There you go. Five different search engines: API, profile, AI model. Look, I can choose from all these different AI, five different AI models. So five different AIs for $20 a month. $20 a month. Oh, I hope it still had my answer. Oh, I was asking it all kinds of questions. Oh well, I asked it a question about the Elliott wave from 2009 to 2020. Oh, look at that. Oh, so sweet. So let's take a look at the S&P 500. Just looking to see if anybody else put up a question. So the AI Elliott wave analysis is saying that we have an incomplete 5-wave cycle because this is saying that the March 2009 to April 2010 high was the first wave. I disagree. I don't think that was the first wave. I think the first wave was from 2009 all the way to 2015, but that violates a rule. That violates an Elliott wave rule. Shouldn't have been that way. I think it was. I do, and here's why. Because at the end of, right, at this crash right here, the 2009 crash, to me, that is the automatic end of the cycle. So it goes up here, it has the 2-year sideways market, has a bottom, rises up until 2018, right? And it was I forget what that's called, an ending diagonal or something. I don't remember all the parlance. But anyway, you have another correction. So 1, 2, 3, 4, 5. Now, it doesn't fit exactly what Elliott Wave says it should be. It doesn't. So what? Elliott Wave is a visualization tool. It is not really a predictive tool, no matter how much those guys say that it's a predictive tool. It is not. It is a visualization tool for having a way of looking at the way things could turn out. And volume in the markets is the ultimate driver of price. So when I use volume weighted analysis, Wyckoff stuff and advanced supply, advanced decline lines and supply demand zones, it's just always looking at liquidity and where that money's going. That's it. And that's all you need because it drives supply and demand. How do you price anything in the market if you're really doing it truly? Supply and demand. Same thing for stocks. So, when somebody says sentiment says blah, 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 okay, what drives sentiment? Sentiment speaks, huh? You know what speaks? Liquidity speaks. Sentiment listens. So sentiment comes from liquidity. So all we have to do is track liquidity, and we can talk about what's happening or what's about to happen in sentiment. Just track liquidity. It tells you what sentiment's going to be, not what it was, what it's going to be. That's a lot more valuable, isn't it? So I think the COVID crash was the end. So I think that we have a new wave 1, 2, 3, little correction, 4, and 5. Ta-da! 1, 2, 3, 4, 5. 5. 5 waves up. 1, 2, 3, 4, 5. Right? That's how I used to count for my granddaughter. 1, 2, 3, 4, 5. And she got very excited when I go 5. So I think we get a little bit of correction here, and then the rally continues. And I think the rally could continue for a long time. Now, I think we get what's called, I believe I have to ask Shooter exactly what the phraseology is here, but like an ending diagonal. So I do think we get to a point and in a jitterbugs, and we have separation. Different assets do well, and certain assets at the top maybe shrink a little bit. And that'll create a situation where you might have wider breadth, more things doing well, but the biggest ones didn't. And since the biggest ones control the index pricing, it'll look like things aren't going up, and yet you'll have probably a ton of mid caps do really well. So I think that we have quite a ways to go up here. I think well into the 600s, and it probably overshoots. I think there's a pretty good chance that by about 2030, we're up around 1,000 on the S&P. So on SPY, we'll see. But the idea that the government's just going to let everything go to hell, it's a dumb argument. They're not. I mean, if it goes to hell, it'll be fast. And they're just going to do what Japan did. They're just going to do what we've already done like 5 times: print more money, right? It's like Doritos. We'll make more. And that's what's coming. The United States is in a better position than pretty much everybody else on the planet because we have all the stuff to put into our things that we need, and we have technology, and now we have some extra labor. So there you go. Somebody asked, what are channel checks saying about Kohl's? Not much, not much. I just went to Kohl's. I had to buy an extra sport coat on the quick because somebody may have outgrown their sport coat and had to get a quickie replacement. So I'm heading the other way, but I just haven't caught up. I think that Kohl's is undervalued. I don't know what the catalyst is to unlock that value, because to me, they are stuck in the old mindset for department stores. I would do like 3 major different things with them if I was running the joint. They haven't called, and they wouldn't let me interview anybody. So I did ask. So I don't know. I'm not excited about Kohl's. I don't think they're going to zero. I don't think they're turning into Sears or Kmart. I just think that they're plodding along, and they'll benefit as interest rates go down. I just don't think that the unlocked potential is big enough to bother with them at this point, unless they really make some significant changes. I think that they need to like really compete with Men's Warehouse. I think that they should have a couple people in there, and they should be doing that stuff, and they should cater to men who need stuff. I went into a Men's Warehouse and it sucked. It was just mind-blowingly bad, and their merger with Joseph A. Bank was stupid. So it's just a crummy chain at this point. Kohl's could destroy them if Kohl's would revamp their men's section and add a few couches here and there and a couple TVs here and there and maybe a cafe, and maybe even bring back grocery stores, because Kohl's started as grocery stores. There's so much they could do with their real estate footprint that would be way more efficient and drive more sales and get way more engagement. And their website is still not very good. It's better than it was. It's still not very good. It's been years. They should have had it fixed already. I don't know why it's taking so long. So should they be better? Yes. Are they going to be better? I don't know. I can't tell, so I don't bother with it. All right. What is my cash position across different kinds of accounts? My personal account is like 95% invested because I'm very aggressive and I just buy my good stuff. My other people's money accounts are 20 to 40% in cash because it's other people's money. And by regulatory standard, I have to be more conservative. So I am selling a ton of puts. I recycle them every month. Several of them expire or get assigned, and then I write more. And so 20 to 40%, I think, is probably closer to 20 is what's right for most people. If you're way up at 40% cash, you got to be spending the next 6 weeks, I think, probably buying, because I think we're going to see a bottom. Now, if the market doesn't correct anymore before the election, then maybe we get a correction afterwards, but it should drop consistent with this. You should get the S&P 500 down to around 500, right? The SPY should get down to around 500. Could go down into, lower. Could get all the way to 400 if things get ugly because terrorists attacked. China, does something icky. Europe, which I did not like the Europe call today. Europe doesn't seem very concerned with the fact that they can't grow. And I don't know why that is. So I'm not really sure. Tariffs, if we're going to get more tariffs, it's not going to happen until next year. So I'm not concerned about that in the very short term. If we get tariffs, the thing to understand about tariffs is they are by definition inflationary. And so we'd have to figure out how exactly we work through that. I don't think it's a horrible idea to require a trade agreement that basically normalizes the expenses between nations. So if like China wants to do business with us, but they're doing this, that, and the other thing to compete unfairly, there's got to be offsets. So I like trade agreements that make everybody use market forces a little bit more efficiently. I understand that you have to protect some domestic industry. If you take a look at the U.S. Steel deal right now, U.S. Steel needs $3 billion, $3 billion to upgrade and modernize. And the Japanese, Nippon Steel, came in and said, we're going to give you the money. We'll be the owner, but we'll give you the money. So everybody's, scary, scary. It's a big legacy company. Historically, it was important. So we can't do that. We're going to pretend that it's a defense issue. What they should do and what makes sense, and remember, sometimes things that make sense happen, is Cleveland Cliffs wants a piece of the action. Nippon's got the money. They really ought to do some sort of joint takeover of the company where, maybe Nippon Steel owns 49% and Cleveland Cliffs owns 40% and the union owns, 11%, something like that. So they could do that, could turn it into a joint venture. They could keep it listed on the stock market, leave 20% of the stock public, right? And just change the nature. Have Nippon Steel say, look, sell us 40% of the company. Sell Cleveland Cliffs 20% of the company. And all that is just cash that goes in. So the problem with Cleveland Cliffs is they can't afford it probably. So maybe what you do is you just cut a deal with them and say, look, we're going to buy iron from you for a zillion years. Whatever. There's ways to make this work without offending anybody's sensibilities, without taking it out of American ownership, and getting your billions of dollars that Japan needs to put somewhere. Put it here. Put your money here. We'll take your money. Why wouldn't we take their money? Right? So anyway, I think that you are going to see this continue for quite a long time. And it's because the very main reason is that we need asset prices to go up and we need employment to be high to drive tax revenues. So they're going to create liquidity. Call it printing money, call it whatever you want. There's going to be more liquidity. Somebody asks, why aren't we filling the SPR while oil is bottoming? Well, first of all, we are refilling the SPR. We've had several orders for it already. And, I guess another reason would be that the reason it's not going faster is you don't want to drive the price of oil up. And I guess another reason would be not to go faster is, does it really matter? I mean, honestly, does it really matter? The EREVs, learn that term, EREV, are basically electric vehicles. They're, people think of them as hybrid, but they're not really hybrid. They're extended range electric vehicles. What does that mean? That means that you only put in about 1/3 the battery. So instead of having batteries in there that'll take it 500 miles or 400 miles, you put in batteries in there that'll take it about 100 miles. That'll cover 95% of one-day trips, right? Most people don't drive over 100 miles in a day. What's extended range? That is a 1 to 3 gallon gas tank with a generator and an exhaust system that's about this big. There you go. And you put that between the wheel wells in the back. You put the battery in the front. You still have all that flat space in an EV, right? Everybody's been in an EV by now, right? No hump in the middle, right? No exhaust system. So you gain all that space. And now by only having a 1/3 battery, it's way, way lighter, right? Because 3 gallons of gas and a generator and a catalytic converter, like an eighth of the weight, or maybe a tenth of the weight of having batteries all the way from wheel well to wheel well. So that's what's going to happen. And that 3-gallon gas tank will generate about 600 miles of range, give or take, depending on the size of the car, things like that. So that means for 3 gallons of gasoline in an EV, if you decide to drive over 100 miles, right, and use up your charge from having it plugged in overnight, you get 600 more miles. And you know what you can do after that? You stop and you fill up your 3-gallon gas tank and you get 600 more miles. So we're going to go from having an average fleet mileage in 30 miles to the gallon or whatever it is right now to like 150 or 200. That's insane, right? So all of a sudden, 60% of our oil is used for fuel, and we're going to be able to cut our, think of it this way: you're going to be able to 6x or more, 5 or 6x your mileage. It means we're going to use 1/5 of the oil on fuel that we've been using, right? And that car, because it only has 1/3 the battery. You've seen what Toyota does with their hybrids and with their internal combustion engine vehicles. What's the difference in price between a hybrid Toyota and just a gasoline Toyota? It's $1,000 to $2,000. It's very close. The Chinese already have EREVs. Google it, or Perplexity it. And what you're going to find is that they're very accepted. Is it 100% EV? Does it do as much for the environment as 100% EV would? Probably not, but it's pretty darn good, right? If you can all of a sudden cut your emissions by, 70, 80%, and your oil usage on fuel 70 or 80%, that's a big deal. All of a sudden, energy security is like that, right? Nobody has to worry about energy security. And that's why these vehicles are being pushed in China, is because the EVs aren't quite economic enough. Now, someday, and I don't think that day is that far off, but I think with planned obsolescence and being able to make more money on selling more stuff more times, I think we go through an EREV. And I wrote an article back in 2014 that we were going to use hybrids. So this is kind of what's going to happen. We're going to do the EREV, still going to have gasoline trucks and stuff because some vehicles need to do it a certain way. But most of the work trucks, Sprinter vans, buses, they're all going EREV or EV. And the traditional hybrid is probably going to disappear. And the EREV, because the torque is real good and because you're going to always have the charge. EREV, I think it's taken off in China, and Farley talked about it at Ford. So, and then they canceled some battery plans. I think they took the charge already. They already took the charge off on the last thing they were going to do. This is easy for them, right? It is easy for them. I mean, this is just 1/3 the battery issues, 1/3 the weight, 1/3 the cost. It's a big deal. So if we are really going to cut our fuel usage dramatically in the next 10 years, and I think we are, and eventually EVs will become more efficient because somebody will figure out how to do air lithium better, or and just make the batteries more energy efficient and cheaper and lighter. So that's all coming. How long does it take? I don't know. I just, nobody knows, right? One day you're gonna wake up, the scientists are gonna go, oh yeah, we figured it out, and then they'll go start working on something else. So that's kind of how that works. My space basket is really focused on 3 stocks. Somebody asked about my space basket. My space basket is, well, hold on. Maybe we should finish up with energy. Oh, somebody just says that Europe is buying natural gas cheap. Yeah. The thing about natural gas is it's going to go up in price again because as oil pumping goes down, you have less affiliated natural gas. So that's really good for New Fortress Energy. I think that the natural gas replacing coal, I do think that we're on the, I think everybody jumped on the, oh, look, more coal is getting used. So kind of, and that was just a demand issue because we needed more electricity. The natural gas replacing coal is about to hit high gear. It has to do with prices. It has to do with prices. It has to do with China knows they're spending all kinds of money on smog related health issues, just like we used to. So all these shifts away from smoggy, polluting things are happening, and it's an all above strategy. It's use as little oil as possible, get rid of all the coal. You tolerate the natural gas until batteries are so good that you can get rid of that too. But that's probably a 20+ year process, maybe 30 years. So you don't have to hurry. The space basket. Okay, the space basket. I'm focused on 3 companies. I'm focused on Spire Global, and I'm going from in reverse order here. because they have the RF technology on their satellites. They're not taking a picture from space. There's a whole bunch of companies that take pictures from space. And I don't think they have quite the pricing power because Planet competes with Black Sky, competes with Satellogic at some point, competes with Maxar. There's a whole bunch of companies that have satellites in space to take pictures. The RF technology that Spire has is unique. They are almost a monopolist, and they just got another huge contract. I think Spire Global is cheap right now. I think it's easily going to $30 a share. It's gonna have I think it's gonna push a $10 billion market cap at some point. It's gonna take time, but I think they're a big deal, and they're important for not only facing the Earth but facing out. Right. So as we explore more, as we do the asteroid mining in the next, by middle of the century sometime, Spire Global is a big deal. That's one company. Rocket Lab is the other one. I think there is another one. Rocket Lab, I think, is because of their integrated nature. I think that you just started to see them break out, right? They bottom. This is a multi-bottom, 1, 2, 3, 4 bottoms. I guess this one didn't quite get there, so that's a A, B, C. So triple bottom, and now it's breaking out, and it's got a target way up here. And there's something to understand about the company, right? It's beyond the technicals. Understand the company. They are vertically integrated. They launch. They have satellites. They have data. Right? They have everything that a space company could do, just like SpaceX. Way smaller than SpaceX, years behind, but they also don't have Elon Musk. And I think that's a positive because there's a lot of people wary of Elon Musk. And I think that the government is going to want to diversify, and I think corporations are going to want to diversify. They're not going to want to be reliant on Elon Musk. So pay attention to the personalities, pay attention to the companies, understand that all the people that need this technology and all the people that need launches, they want certainty. They don't want to be hamstrung. They don't want to be caught. It's risk management for them. So Rocket Lab as an alternative to SpaceX, I think has huge upside, like S&P 500 size company. So, SpaceX has what their last capital raise. What did they get valued at? $120 billion. I don't think these guys are going to get there, but they might get to 20 or 30 billion pretty easy, right? And then maybe higher. So I think Rocket Lab is an easy one. I think it's just starting to move in your direction. Sell puts on the dips and buy stocks on the dips. And I think you'd be aggressive about it. I'm trying to get to a full position. I got to see if my puts, my $5 puts are going to expire. I think they are, but I don't know. They're October's. And then the one that I'm the most into right now is AST Space Mobile, and we talked about it, right? So somebody wanted to take a look at the relative strength index. That was one of the first questions. So typically, you get what's called a 3 drive, and the RSI will get overbought 3 times before the stock really corrects. So this is the first one. It's down here. It's probably gonna come back up here again and come down and up here. You could argue this one too, but if take a look at the share price. Share price didn't do anything meaningful, right? So outside chance that this one counted, I don't think so though. So I think you get 3 more waves up in stock price, and then you have to be careful at that point, because when you use RSI as a shortcut, it's not, it's over 70, I have to sell. That's not what it means. It means that now I have to monitor it because it's going to jitterbug around up here before it falls off, right? That's how it works. Jitterbug, 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 blah, right? Like this one. I have nearly a full position on Spire and Rocket Lab. Yeah, I'm trying to get there. So Spire I had trimmed at one point and written some covered calls, and then it fell. And yeah, so I'm, by virtue of having that scaling in and scaling out strategy, I don't have as big of a Spire position as I did, back when it was whatever it spiked up to 14, 15, 16. Black Sky's Planet, I'm looking for exit strategies. I think they can double the triple, but I don't think they have the 10x potential anymore. So I'm looking for an exit strategy on Planet Labs and on Black Sky. I think Black Sky with their reverse split is about to do very well. So where can this get? I don't know. I mean, this actually makes a lot of sense. I mean, this is where some probably some pretty smart people resided, right? So smart people are buying, maybe some smart people, bought in here too. So I don't know. I mean, 5 or 6 on Planet. Black Sky just did the reverse split, and so that's a triangle it's going to break out of. I think they're in good shape. So I'm not buying anymore, but I am looking to figure out where is this going to go. So here you have this. I mean, could it get to 30ish? Maybe. I don't know. It's hard to know. These are companies that got, it's kind of like the teledocs of the world. Great idea. Everybody got in on it. So much competition that it soaked up a lot of the potential revenues and profits. Great technology, great business, lots of competition. You're looking for pricing power. You want oligopoly conditions. You want pricing power. So when a company has very few competitors, or the competitors are aligned on pricing, right? Collusion, you get more profits. So that's why insurance works the way it does. It's opaque. They don't pass on any of the savings from technology to you, and they have an underwriting process that allows them, even if they lose money for a year, to get it all back the next year. So now I think insurance has had its great big gain from AI and systems improvements already. I think they were one of the first early adopters of that. I know this because I talked to adjusters at a couple of different companies, actually going through it with Progressive right now. So I just don't see Planet and Black Sky, because they have lots of competition, having as much upside as I thought they did originally. I just didn't think they'd get this much competition as they did. And everybody can throw a camera in space, apparently. Who knew? So, anything else before I go watch TV and fall asleep playing poker? Nothing. All right, it's after 8 o'clock at night here in Milwaukee. The Brewers are going to make the playoffs. They're going to win their division, and they're probably going to disappoint me in the playoffs again. So I'm going to be very downbeat on the Brewers, because if I'm downbeat on the Brewers and not excited, then probably we can win. I have no idea what this T-shirt is. It's yellow. I wanted to wear yellow, so I grabbed the yellow T-shirt. I don't know. It's a bird. It's a hawk or something. I don't know. I don't think it doesn't say anything. It's just a bird. Some bird that eats little critters. All right, everybody, have a great night, and I will get this edited in the morning. Take care. Yep. One of these days, I might open a restaurant. I'll just tell everybody to fly in, and you can have your Kirky meatball coupon. All right. I mean, that sound right, but whatever. Well, we'll see if I get rid of it on the edit. All right, everybody, take care. Have a good day, and join the chat rooms. I'm telling you, join the chat rooms. You don't have to post anything, but take a look at what's getting posted. Lots of great articles, and I answer questions there too. So, all right, take care.